All right, good afternoon, folks. All right, before I before I get started, I'm going to check Twitter real quick. If you would be so kind as to let me know that you can hear me, you should be able to see 5 charts on my screen right now. So if you hear everything fine and the volume's fine, just give me a 5 by 5 and that'll give me a confirmation you can hear me. Thank you, Gregory. Just want to see one more just to make sure. Institutional order flow trader, thank you. Thank you, Destiny. Silent Watcher, Yaten, and Reza. Thank you so much. All right, so I'm going to get through this as quickly and as painlessly as possible. I have a lunch date downstairs with my wife, so we're going to be eating Mediterranean here this afternoon. So happy Sunday to you. Hope you're all doing well. Hope you're in good spirits and in good health. We're going to start with the dollar index, then we'll go into euro dollar, pound dollar, S&P 500 futures, NASDAQ, and before I close, I will look at gold. Okay. So let's start with the dollar index here. On the weekly chart, I'm just going to go through it as I talk. This area up here, I've mentioned this before, so we're working with a virgin chart. Everything is fresh, as I would expect and see if you were not with me like this, and if I was by myself just looking at things. I'm not annotating the chart this way, but I'm writing down the levels on my notepad, meaning that it's this candle's low, this candle's high, and the range between those two respective price points. Which is the consequent encroachment here. So at 108.85, that's consequent encroachment of that SIBI or sell side imbalance, buy side inefficiency. So that level's on my chart. I'm sorry, it's on my notepad. It's not on my chart. I like to keep my charts clean. And you're probably asking yourself, why do you do that? Why don't you just have them on your chart? Because I want to be able to be flexible. And I've learned that if I have the levels on my chart, I can tend to marry the idea, especially if it's something I really want to do, or if it's something I've already talked about openly and I've publicly shared it. And if I see it on my chart, it's in my subconscious that I want to see it be traded to anyway. So between the two, it might cause me to ignore the real-time changes in sentiment, the change in order flow. The narrative may change, and if I don't have them on my charts, it's easier for me to switch up and change gears and reverse my entire analysis right there on the spot, which in the beginning, you shouldn't be wanting to do that. Okay. And when you hear me say that, you're thinking, well, that's what I want to be able to do. And if you don't have the experience, what will happen is you'll end up trying to change your mind too soon, too many times, and you'll just go back and forth, back and forth. Okay. And really do nothing but just churn your account, run it down, draw down, and or blow it out. So it's just a means for me to keep myself fluid and not try to marry the idea that I have an interest in a particular level. And I like to keep my charts clean. So there you go. It's also one of the additional things I'm looking forward to post November 11th, where I'm not doing so much engagement all the time about my personal analysis. So it'll be back to the way it used to be for me, just using a naked chart and not feeling inclined to tell everyone on the internet what I think is going to happen. All right, so that imbalance, I have that noted. And going back through price action, we had this small little inefficiency here. We talked about how it could potentially trade back down into that if we were going to correct. It did that and went past it just by a little bit. That's completely permissible. We're not making a big deal about that. But there isn't really any inefficiency to speak of beyond that in here. It's a small little one, but it didn't really quite get into that between this candle's high in that candle's low. So we didn't even get below this candle's low to even be a factor for it. So it just overshot this gap here, and then we went higher. One of the things that I'm interested in is how we went right back up to previous week's consequent encroachment of that wick. See that? So the dollar index went right back up to that level, stopped after going by just a little bit, and then came off the high of the week. If we start pressing into, and it would need to close on a daily chart, okay, and this is a weekly chart. Look up here in the upper left-hand corner. That's a weekly chart. So if we look at this in terms of the upper quadrant, that would be here. If we had a daily close above that 107.055, if we have a daily candle close above that, then I would expect it to trade above this high and start working into this inefficiency. As long as we remain below this upper quadrant, the specific 107.05, I'm anticipating it ranging between the low of last week and that level, that upper quadrant. So in other words, we're looking at this as a range until we get on a closing basis above this particular level here. And that close has to be on a daily chart, not a weekly. It has to be on a daily basis. So on the daily chart, if it were to close above this price level here, then my focus is going to be expecting it to go above and trade up into this area here. Okay. You might be questioning, the question may have arisen that, okay, what happens if it just goes to that level and keeps on going and takes out that high? Well, then it goes without saying. It still remains the same. I would expect it up here. But for the sake of leaving this pre-week open, because right now it's 12:52 p.m. on Sunday, my local time in New York, East Coast time, that is before we have an opening bell or opening session, later on, a couple hours from now. So I don't know where we're going to open up at. There's a lot of things going on around the world between now and then. Some unexpected events could unfold, like we saw happen 2 Fridays ago, or a Friday ago, and between Middle East and Gaza. So there's a lot of tension there, and a lot of spillover that's potential going into other nations, other countries, and all of that concern is ramping up the flight to quality, or the safe haven aspect of the dollar index or the dollar. So the reason why I'm saying that I want to just call the market ranging between these two levels here, this week's that we just closed high and the low of that week, we're going to work inside that range until we get a definitive close on a daily basis above this upper quadrant. Ultimately, this is where I believe we're drawing to that. I have not called a top in the dollar index. I'm not trying to do that. We did see it trade up into that level here, and I'll just annotate it with the horizontal line. We saw it trade up into it 2 weeks ago, hitting it here, and then we retraced, and then we came right back to consequent encroachment here. So what causes me to call for a trading range environment until there's a definitive close above the upper quadrant? Why did I say that? Because you're probably thinking, what makes you think that way, ICT? What makes you think that it would do that, not just keep on going higher? It can go higher. I prefer that it would, but because I don't know where we're going to open up at, and I don't know what's likely to occur because of some kind of terrorist action, some kind of war response, all those things are going to, rev up these sentiment ideas, and fear and greed will start coming into the marketplace, as we'll talk about with gold later. That makes it a little bit different in terms of a normal market delivery. So there's a whole lot of fear in the marketplace right now. And we're going into the last quarter of the year where markets have a lot more activity. And whoever's trying to make money this year, they're going to try to do whatever they can before the close of the year, because as we get closer to December, it's less likely for new risk to come into the marketplace. It's a winding down as we get closer to the second week of December, and then we get expecting the markets to start to soften up, barring any kind of crazy 9/11-esque type event where it would cause the market to go haywire. But why the range here? Because we didn't trade above this weekly high. We went just to consequent encroachment, just a little bit above it, but failed to get above this high here, and ultimately stopped with no close above the consequent encroachment or midpoint of this longest wick. Okay, so if this would have traded and closed above this one here, I would say we're going to roll right into follow through, going right from Jump Street Sunday later today, and we would start working towards here, and all week long we would just gravitate up into this area here. But because we did not get above 2 weeks ago's high, and because we didn't close above consequent encroachment of last week prior to the, not last week, the week prior to the week we just closed here, this tends to create a need for consolidation. If I'm wrong, it's no skin off my back, because either way, I'm subscribing to the idea that the dollar goes higher. Okay, so there's no plan A, plan B. If it goes down, I'm right. I'm saying I want it to go higher, but because of the delivery of it not getting above this 2 weeks ago's high, and the week ago prior to the one we just closed, it didn't close above the midpoint. Okay, let me put this back up here so we are following one another here. It should have, in my opinion, should have closed above this 106.76. It should have closed above that. It didn't. It just returned right back to consequent encroachment and came off the highs. But in this run higher, it didn't even get above the high of 2 weeks prior, which is here. Okay, you see that? So 3 weeks ago, its high comes in at 106.839. Consequent encroachment of this wick on this weekly candlestick here comes in at 106.761, which is lower than the previous week. But the week we just closed wasn't able to close above consequent encroachment, and it wasn't able to trade above 2 weeks prior. So it set up a scenario where I could be wrong. It could trade down and go lower and work inside this area here where I was talking about a little bit ago, where it might be that it does this very thing here, this week. I'm not saying that that's going to happen. If it does that, I'm wrong. Is that very finite? It's very specific. If it does this, if it trades down to there, then I'm wrong about my pre-week opening analysis. So what I'm expecting and what I'm anticipating going into the market before we even see the opening price later today on Sunday, I'm subscribing to the idea that we're going to remain in this range until something drives us above the upper quadrant of this wick right in here. And it has to close on the daily chart. And once it does that, then I'm confident that we're likely to continue higher, and then we'll work towards those higher time frame imbalances, or imbalance rather, on the weekly chart of NASDAQ, which is this one right up here. Okay, so that's a long way around the barn to explain why I believe what I'm expecting and why I'm comfortable, working with this idea. We'll drop down to the daily chart. I promise they won't all be that long. Keep talking, ICT, keep talking. All right, so here we have the daily in that range. And it's nice that we came down, took out that sell side here. Had a really strong reaction here on Thursday into Friday. And this looks too much like it wants to consolidate a little bit more. We have an imbalance right there. So we could drop down into this. I prefer it stay open, to be honest with you. So what I'm highlighting here, I'd like to see this stay absolutely untouched, not covered up at all, not repriced to. Just simply leave it open as a breakaway gap. That's what I would prefer to see. And draw in a blank here. I don't want to extend the right. There you go. So this buy sign of balance, sell sign of efficiency, I want to see it act as a breakaway gap, meaning that I don't want to see the entirety of that range closed in. Can it come back down and touch just below this candle's low? Below the 106.78 level? I'm sorry, below the 106.29, which is the low of Friday. Can it do that and then go higher? Yes. I'd prefer that it didn't, but because I don't know where we're opening on Sunday, and I'm not going to trade on Sunday, and I'm not going to trade on Monday without having something that's so obvious. So right now, I'm willing to just lay down and not take any action on Monday. That's I want to see what we do with this new sentiment over the weekend. There was supposed to be some big, response globally, and it was rather, mute. It wasn't. Thankfully, it wasn't a whole lot of things going on. Doesn't mean that it won't happen at a later time, as I believe it will, but it just means that it may have lulled people into thinking that we're okay. There's no reason to be concerned. And people like myself that have been around for a little bit longer than the average person trading today, we know better. We want to see, okay, let the market open up and see what they do with this information, this insight, this new sentiment. Does fear grip the marketplace when they send it higher in the dollar index, signifying that it's flight to quality, it's a safe haven move? I don't know, because we see gold rallying. And this is why we'll talk about gold in terms of an event-driven market. But right now, dollar index, it could just hammer around inside this range here. It could very well come down and overlap this fair value gap. And guess what that means? It means I'm not taking that as a long idea on dollar and short on euro or cable. Why? Because I want to see it do what did I mention on the weekly chart? This is where everybody likes to take things out of context and say, but you said this and you're wrong. No, you're not listening. I'm not interested in taking a trade this week until we have a daily close above the upper quadrant on that weekly range that we just showed on that weekly long wicked candle 2 weeks ago. It needs to close on a daily chart above that level. When it does that, then I'm interested in trading. If it goes through it intraday and it keeps on going higher than that previous week's high 2 weeks ago, then okay, that's the same thing for me. But the bare minimum is that I want to see that close above the upper quadrant of the range of that weekly wick 2 weeks ago on the weekly chart. So I don't even care if it drops down into this. It doesn't signify for me a buy. It just means, okay, once it gets there, I want to see what it does. I want more information. Why am I doing that? Because I'm being cautious. Because I'm going to be risking real money, not demo. Okay, I'm not going to be trading a market replay. I'm going to be doing something with real money. So therefore, I want to have a little bit more assurity behind all the things that's going on around the world. All it takes, folks, all it takes is for something to blow up at the right place, at the right time, in the right country, and all hell breaks loose. And then these markets will start doing things that you've never seen before. So you have to be very cautious. There's high levels of risk right now that you have to appreciate, and you just can't think, well, all these things going on causes great market conditions. Well, yeah, after the event takes place, yeah, but you don't know what's going to pop off next, so you have to be very careful, very, very careful. So hopefully I made that very clear. Just because if it comes back down here, I don't see that as a buy for dollar and sell for euro dollar. If it does that, I'm willing to let it go without me. Not that I'm even trading Forex or pound dollar or euro dollar, but for those that are following me, and it's predominantly Forex folks that follow me now. But I'm trying to build the audience up with the more gentlemanly traded market or asset class, which is futures. Even if Forex falls away, you will always have index futures to trade and commodities. So that's a market that won't ever go away. The imbalance trading into it, it's just something for me to watch and see, does it respect it? If it trades below it on a daily chart and closes below this buy side imbalance, sell side efficiency, then that means I'm probably going to see a lower run here, and it would need to go through just a very, very small little movement and then snap back higher, and then still resuming with the idea that if it has a daily close above the upper quadrant of last week's range, or 2 weeks ago rather. Let me go back. That's probably just confused you. It needs to get above the upper quadrant of that wick right here, which is again why I write my levels down. And it needs to close above this price level here before me to engage anything. Okay, so I've placed a filter on my engagement this week, and unless it does that, I'm not touching it. What happens if it sells off and goes a lot lower? I've missed it, and I've done nothing with it, and I'm okay with that. How's that for logic? I am very, very careful right now because I don't trust that something wild and unexpected going off somewhere won't occur. I believe it will. So because of that, I'm being very cautious about what I'm anticipating. And if it does this very thing here, I will feel confident that it's going to go higher on the dollar. And it might be a short period of time where gold and dollar move together, which is not historically what you would expect. One goes higher, one goes lower. They're usually diametrically opposed. But because we watch Thursday and Friday dollar index, let me just do gold right after dollar because it's a little bit easier for me to segue. That way I won't forget about it, because the chances are I might do it. I might get into a rant a little bit after we close up with NASDAQ, and I'll forget, and then I'll be all upset about it, and I won't be going and doing another additional review. I'll just be mad about it, and I'll be tweeting to you about what it is, and I'll hate my evening because I didn't do what I wanted to do. So we saw Thursday and Friday trade higher with the dollar index. So if we look at gold right out of this market into what would normally be a diametrically opposed delivery, look what we're seeing here. See, gold and dollar are moving in tandem. That's something that I don't like to see. I'd like to see where there is a diametrically opposed delivery, where a symmetrical market would be where dollar goes lower, gold is permitted to go higher. It doesn't mean that it will go higher. It just means that it's most likely won't go down. It can consolidate and slowly work its way higher, but either way, it should not be moving in the same direction. Now, what causes these types of things? It's an event-driven market. Gold is highly manipulated, and it's also treated as sometimes as a safe haven market as well. Couple that with the fact that there's central banks around the world that are really trying to build up their gold supplies because they're going to be doing central bank digital currencies. And they're going to try, like the BRICS nation, they're trying to sell the idea that their currency that they're going to release later on will be a gold-backed currency. So it would demolish the dollar because it's built and based on an idea that's an illusion. This is what we say it's worth. Do you believe us? That's the honor system. Okay, it's not like it used to be. When it took us off the gold standard, it became an illusion, and then we created this relationship with Saudi Arabia. Said, look, we're going to protect you as long as you make everyone buy your oil with dollars. Well, there's a departure from that right now, and we're seeing this shift away where Saudi Arabia is now allowing an interest in purchasing their oil outside the dollar. So we've never had that since we came off the dollar index. I'm sorry, since we came off the gold standard. When Nixon took us off the gold standard, we basically had an illusion of currency. I mean, they're all illusions, really, if you think about it. But we really had an illusion that there was nothing behind our currency. So we started playing the mafia with Saudi Arabia when nobody was attacking it, and said, hey, look, we're going to protect you, but in response to that, you do us a solid and only sell your oil through dollars. It has to be US dollars. So we've been allowing our own currency to be propped up by the sale of another country's commodity, which when you think about it, when you really can come to terms with it, it's really asinine. Like how is that? Like that shouldn't have been like that ever. And now that country is departing from that arrangement, not entirely, but it's allowing. And I think what it's doing, it's got its toe in the water to see what will we do in response. Well, when we're staring at Russia and China together in a fortified union, building on opposition to the greenback or the dollar, we're doing nothing. That's what we're doing. We're sitting back and letting them do whatever they want to do because we're technically outnumbered. And it's been checkmate for 2 years now. And nobody really understands that. And all the other nations are slowly siding with those BRICS nations. And you're actually seeing the culmination of that last beast that the book of Daniel talks about. And I'm not going to get into that here, but that's what I see happening. And we are in dire straits economically when that becomes full on and they release their currency where everybody sees it's gold backed. There's nothing holding up our dollar then. And then we will see Venezuela 2.0 right here in the United States. And it's going to happen real fast like that. So because of all those factors that are weighing heavily on my decision making, that's why I'm not also trading in Forex, because I think there's going to be a decoupling that's going to happen so sudden that brokerage firms, financial institutions, banks, traders, they're all going to get destroyed real fast, because it's going to be just like the euro dollar and the Swiss franc when there was the decoupling. It was like a nuclear bomb going off. I mean, business as usual after that happened, but it was very scary seeing huge runs, 1,000 pip swings instantaneously. You're not ready for that. And I don't care if you're trading on a funded account and you think you're safe. Those things won't be around after that. That's what I'm trying to explain to you. Like that, I'm not willing to invest in Forex because of that very thing that's looming. That's not to say that that can't create reverberations and ripples so large that they wouldn't be painful in futures or commodities or, well, I said it, index futures, but in bond market, they'll have them too. But currencies are that's where the target is right now. The target is currencies. They want to have a smaller basket to choose from in terms of currencies. And the first thing they want to take away is the dollar and the influence that we've had over everyone else's nation, and tried to be the world police and use it like a sharp stick and say, you better do this or else. And now all these other nations that are just as powerful, if not now more powerful than US, because they've outnumbered us. On the chessboard, there's too many superpowers that are standing against us in opposition, saying, we don't need your dollar. And the average person isn't aware of that. They don't think that way because they have their dollars coming to them in their paycheck. Even though it's more expensive to buy everything, that's the extent of their visibility. They don't see anything past that. So there's a lot of concern that all of you should have, and you should be trying to do whatever you can to fortify your home with things that you may need, because our currency could be devalued rather quickly. And what you think you have in the bank versus what you actually had to spend with it is totally two different things. And that's further communicated given the total global climate where we are. There's a lot of saber rattling and war talk amongst nations, and gold rallying up like that while the dollar's going higher too. So I want to see what continues on Monday. Sunday night, a little bit later today, when we see the market open up, does gold go higher? Does dollar go higher? Because one of the two is going to not do it. One's going to give up. And I'm thinking that at least for the first couple days, gold will continue higher and dollar can consolidate. Now, do you see why I said all I said about the dollar index? And I just can't simply say it in a 5-second expose of what it is I'm contemplating. There's a lot of factors that weigh on why I said the very things I said in just a few minutes of talking about. I want to see it stay in a range, or I'm anticipating it staying in a range. But my focus is what we're seeing in gold, because gold's going to be the catalyst behind the follow through higher on dollar, or if it's continuing higher for gold, and gold wants to run for the buy side here. If it wants to run there, that means that it might cause dollar to stay in that range I outlined. And then once it gets here, does it power higher? And if it does, then it's going to probably send that dollar index down into that daily fair value gap, which again still would not mean a buy for me. I would need to weigh out what gold is doing at the same time that the dollar index is dropping down into that daily fair value gap. Okay, so there's this teeter-totter effect. I'm balancing out two markets that are closely correlated, but they're usually inversely correlated, meaning one goes up, the other goes down. But because of all the things that's going on right now, they're moving in tandem. That's not a normal function or symmetrical market. You want to see a market environment where you're willing to take on risk, where they're doing the opposite of one another. That is a symmetrical market. That means everything is on the level, meaning that if you're bullish on dollar, that should be weakness on gold, or there should be no strength in gold going higher, and all foreign currencies should move lower. Equities should start going lower and have a short-lived rally. If it does rally, they're suspect rallies, they're fake rallies. They're just going up to go into an inefficiency and quickly reject it, or go up above a short-term high, then reject it. That's how you use the dollar index. But just because we're bullish or bearish on the dollar index, if you're not factoring in the effects of gold, because gold is the qualifier of dollar. So you're not just simply looking at dollar index and thinking, oh, well, it's going higher. You can't just look at dollar index going up and assume everything else mark to market should go lower. It doesn't work like that. Forex pairs and forex currencies, those types of markets, yes, they many times will work marked for market. Mark to market, it'll be usually on par. Euro for certain, because the dollar is heavily weighted with the euro. But other currencies, like the pound, tends to do whatever it wants to do. Pound is like the NASDAQ of Forex. Yeah, it might bend the knee to, lower prices on whole, but it's going to buck back when it wants to and be unruly. And also, when it does move, it's going to move at an accelerated pace, just like cable does. Cable's pound dollar. So when the market's predisposed to go higher or lower relative to the dollar index going higher or lower, euro is tending to move mark to market with what the dollar index does. But if it's bearish for euro and bullish for dollar, cable can over deliver and be exaggerated to the downside, which is when I was trading Forex. That's why I elected more times than trade the pound dollar than the euro. Euro tend to be a little bit too slow for my liking, which is why I trade NASDAQ more so than I trade the ES. Even though they should move in tandem with my overall macro analysis, I tend to use the NASDAQ because if I'm on side and I'm correct, the moves can be exaggerated in my favor. Now, it's a double-edged sword, because if I'm wrong in my analysis, if I'm wrong in my entry, then that means I'm going to sit through a little bit more drawdown or have a larger loss than that would have been taken if I would have traded simply the ES, because it's going to be a slower market. But each one of them have their inherent risks and their own characteristics, and I like to be in a market that's going to be the exaggeration, the one that does more than you would expect. That's always a good thing. So anyway, that's enough for gold. That's what I'm using it for. That's how I'm interpreting it. That's how I'm used the gold in the analysis of dollar before we got to this market here. So now there's no necessity for me to go back to dollar. I've closed that chapter and I've talked about gold. So now we can go into euro. All right, so here is the weekly chart of euro dollar, or fiber. And let's zoom in here a little bit. I hope that made sense. I mean, I know some of you are really, really new, and it might have went over your head or a little bit confusing, but I promise you it's not all that complicated. But knowing or having the experience to anticipate these types of things, it's not reasonable to expect a new trader to think that way, because no one's actively teaching that part of it. I mean, everybody knows that dollar up is risk off and everything else should go down, but it's not simply limited to that. There's a whole lot of other things that have to come along with that. And in my experience with a lot of books, reading, stuff that really is regurgitation, I didn't find a lot of value in that stuff. So there's a whole lot of other factors that aren't ever really discussed that I just shared with you. So hopefully it'll carry you through your career with help. So we had this volume imbalance. We traded up into that. It's just all old news, and it's moved lower. We went below here. These relative equal lows, we had sell side taken. I did not say that we were at the bottom. And the same thing I'm saying in terms of the dollar index. I think that we gradually move higher on dollar, but as to what catalyst, that is the What's the driver? Because if we start seeing a lot of terrorist attacks, if we start seeing a lot of those things happening in mainland US, the dollar index is going to go parabolic. Like it's going to go straight up. And that also might accompany a rise parabolic in gold. If we see those types of things occurring, like buses being blown up, buildings being blown up, things happening in the New York Stock Exchange or near the New York Stock Exchange, or army bases, military bases, and things of that nature, or large gatherings of people. Okay, and we start seeing the stuff that goes on in Gaza and in Israel. If that starts happening here, that's going to cause so much chaos and fear, and these markets will rev that up, and it'll exaggerate it and cause people to be fearful about their money, and that's what it'll be used for. So if we get all those things happening, euro could accelerate rather quickly right down into this area here. Ultimately, before the end of the year, I think we're going to trade into this. That was my quarterly shift analysis. I was expecting this type of thing to occur. I'm still selling the idea that that's what I believe is likely to occur. I believe that the dollar index will go up into the inefficiency I mentioned. So between both of those two markets, we're seeing where I shouldn't have it this color because it doesn't stay with the historical use of the colors. So I think that if we have a ramp up of violence and things that are hopefully not going to happen, but if it does, that's going to cause the markets to go through a state of panic. And panic will be accelerated by the fast delivery in the markets. And they will use that going into next year. So how they being the market makers, the central banks, that's who the market makers are. In case you want to know who they are, it's them. So when that happens, if it does happen, we'll be looking for euro to try to trade down into this area here. It doesn't mean it won't go here and stop. It just means that I see it wanting to get down here, okay, in this area. And because of all the things that's going on in the world, it could be delivered rather quickly. So everything I just mentioned with the dollar early on, just apply that to this in terms of expectations, but just reverse it in terms of the direction, because I'm expecting higher dollar. I'm not expecting lower dollar. I'm not calling a top in the dollar index. With all the things going on around the world, there's absolutely zero reason to anticipate or expect a high in the dollar to be formed, period. All right, so here's the daily chart on euro. Okay, and there's no inefficiency in here that I feel is noteworthy to anticipate a retracement down, then go higher. Normally, okay, let's say it this way: we could see this low, high, lower low. If we're in a bullish market, if we're in a bullish condition where dollar is absolutely bearish, then this run up here above this high, this would have been viewed by me as a shift in market structure. Okay, for the folks that ask this question a lot, what's the difference between a shift in market structure and just a run on stops? Well, you have to have a macro understanding of where the market's likely to go, and that's what I've spent the most time so far discussing today. What is the underlying narrative that I think is going to be implemented, or what I'm going to submit myself to? And if it does this, then I'll engage this week. If it doesn't do these types of things that I'm looking for, I'll have nothing to share with you. I won't be able to say, here's a trade I took. I won't be able to do any of that stuff. I won't be able to point to anything on Twitter beforehand like you see me do every single week and it happens. I'm going to be reserved and quiet because I want to be watching and seeing what takes place geopolitically, on the war front, what's going on over in Gaza, what's going on with Iran, what's going on with all the other Arab nations. I'm watching all of that. That's where my focus is. My students have been telling them, watch the Middle East because that's what's coming. Well, now we're boiling over now. That pot is boiling over, and all of us are going to get burned by it. Just because we live on the other side of the world doesn't mean anything. Think about how many people have come through our southern border. We don't know what's going on. We don't know what's going to pop off here, but it could get real busy here real quick. And that could speed up a whole lot of fear in the marketplace. And they will use and capitalize on that fear and reprice aggressively, way beyond what you expect. Way, way, way beyond what you would expect in terms of your targets. So it's also occurring at a time of the year when there's larger range expansions anyway. There's bigger movements in these months going into the end of the year. So if we had a bullish dollar, if we had a bearish dollar, and all factors that I've mentioned outlined here were not so, and it was expected to go lower for the dollar index, this would have been a bullish breaker and it would have never went this low. Now, because there is this small old gap right there, here's for your notes, that little inefficiency right there, right now, that's what it keyed off of. I have to put this border on it because if I don't do it, it's going to drive me nuts. So this inefficiency, we traded down into it there, okay? Just a little bit past the midpoint or consequent encroachment of it. When it's like this, and I'm expecting the dollar to continue higher. It may need to consolidate a little bit, but ultimately I think it's going to go higher because there's no reason for anything to be expected to smooth out. Like the stuff that's going over Israel and Gaza, that's not going to go away anytime soon. Like there's a lot of anger and a lot of pent-up hostility and retributions are sought after. So that stuff's just beginning. And because of that, I don't think that we're out of the woods yet in terms of the dollar going higher because it will be treated as a safe haven. So if we are long-term bullish on dollar, but just expecting some initial early week consolidation, early week of this coming week is what I mean, then hopefully we start seeing the dollar index resume going higher because that's the catalyst in the narrative that I think is in play or potentially in play this week. All of this movement here above this high would have never had me going in looking for this as a bullish breaker because we have the low, high, lower low. We moved above it. It's a shift in market structure. No. There's no fair value gap in here because we've had all of this overlapped candlestick running all the way over top this range here. This candle here overlapped most of the upper portion of this wick here. Then this candle, we went down a little bit and it went higher. So there's a whole lot of back and forth movement across this candle, this candle, this candle, this candle, and this candle. Now, while we're dropping, to me, I think this is a meaningful drop because I think we're going to go lower and take that low out. But since there's only this gap here, we went over top of it here. We overlapped it, right? There, went through it. Does that mean it's gone? No longer considered worthy? No. It means that my eye jumps right to this, and this becomes a potential inversion fair value gap. Meaning that I'm expecting it to do a move lower, come back up, and treat it as resistance. I'd like to see, if it retraces back up into it, I would like to see it stop at the halfway point after moving below it. If it does that, then I'm really, really bullish on dollar. Then I'll be really, really looking for shorts in NASDAQ. You see how everything is blended together with this, that? The whole explanation about what I'm looking for, why I'm thinking it, why I will expect it, why I'm cautious, what am I specifically waiting for? That's experience. That's knowing what to do with the models. That's also knowing and trusting myself as an individual and also respecting in the increased measure of risk right now. I'm okay with letting a price run happen on a Sunday. If we get an extreme gap opening somewhere and it starts running a lot, who cares? I don't care. I don't need that to be profitable. I don't need that to define me as a good trader. You don't either. You want to be able to trade and trade in high probability conditions where the risk is realistic and manageable, not infinite. You don't know where it's going to go. Like your risk right now, if you carried over a long or short from Friday, you have no idea where we're opening up. That's gap risk. I don't want gap risk right now. When I trade, I don't trade with micro lots. Okay, I'm trading where if I'm wrong, and we gap a lot against me, that could be a lot of money. And I don't want to have a lot of money taken from me in a condition where I have no control. I have no control of where we're opening up on a new week. So I teach my students to know that there's no mechanism. There's nothing I have as a tool or a repertoire. No algo, no macro, no secret little thing I'm never going to make public. I have zero tool for the opening price of the new week. I don't have that. That's always going to remain a mystery. I'm not going to be able to figure that out. I've tried and I don't know how to do it. So I've no longer invested any time and energy into it. I've wasted a lot of money trying to trade with real things to build what I thought was a model, and they didn't hold up. So I'm convinced that that's not a worthwhile venture to try to dig into figuring out. It's not necessary. Once it opens, then now we have information. We can worry about what it does after that opening price is made and where we closed the previous week. So that's your opening range, new week opening gap. So a long way around the barn to say that because this gap is here, we've already went through it here. We went down into it here. So if we go through it once more, I want to see it respect the midpoint of it and not trade up to the upper high. It can do that, but why would I not want to see it trade to the upper portion of it? Because it would imply that it's exceedingly weak, meaning that if we trade down on Sunday or Monday rather, and we get back up into it and touch the low of this inefficiency, which is this daily high, up to the midpoint, which I'll actually give you the level. I'm so nice. No extra charge. How about that? So the level here at 1.04969. So let's call it 97. 104.97. So as long as it gets to and remains below 104.97, if it starts to drop there, I will trust that it will remain weak because I'll treat the upper portion of it as the same way I would do with a breakaway gap. It would imply exceedingly weakness, and I would be bullish on dollar, and therefore I would look at every rally in NASDAQ as a suspect rally to fade that. And then every time it creates a new fair value gap that would be a short, I would be confident doing that. So I've literally outlined everything that I would like for this week. What would constitute a high probability scenario? What am I waiting specifically for? It's not random. It's very specific things. And then unless it does these types of things, I would not take any action on it. And regardless of whatever the market does, I can be comfortable and not have any FOMO. I'm not fearing of missing out on any of these moves that takes place because what I've framed out is what I'm comfortable with, and incurring risk around it is an acceptable thing for me. These things may not be what you're subscribing to. It may not even be your model. You may have something entirely different that you're trading with. And you think that what I just outlined here makes no sense to you and you wouldn't use it. That's your business. You're welcome to have that. But for me to have something where I'm going to show you an example, this is what I did. This is how I used the information I talked about on Sunday before the market opened up, because you can see right here, we're doing this live. It's New York local time. It's 1:34 p.m. The market has not opened up yet. I'm co-signing all this before it happens. I don't know if I'm going to be correct. But notice this. I am disarming everyone. There's nothing to hold on to be right or wrong right now, because I have laid down the foundations about what it is I want to do to trade anything this week. If it doesn't do it all this week, guess what happens? I've taken no trades. Are you willing to go through an entire week without taking a trade? Chances are you're probably not, because you're all hopped up on goofballs. Like you're gambling. Like you're trying to do something because you have time to do it. I want to trade because I want to make money. I want to sleep at night knowing that what I'm about to do and take a trade on, it's reasonable. That risk is reasonable. If I'm risking $6,000 on a position, that might seem crazy to you. But that $6,000, if I do a double portion of that same trade, it might be a $12,000 risk. My stop loss could be $12,000 in the size of my position. But I'm comfortable taking on that risk. You can't even trade that in months of profit. But that's a trade that I'm willing to accept if given these types of parameters. If they're met this way, I can take a trade like that and feel confident that I can get 50,000, 75,000 out of the market off of that move. So everything's relative. Everything is a matter of what fits you. But everything I just said could be scaled down to you this week. You could use everything I just outlined in the scope of a micro lot. The smallest of the profit and loss potential that's given to you by the risk and leverage that you use, whether it be forex or futures. You have to scale it for what you're comfortable with. For me, because I know there's a likelihood of a lot of excitement, a lot of big moves can happen. I'm not just going to sit down and wait for something that just feels right. I need to know that I'm using the higher time frames. I know that I'm referring to and conferring with other markets that are indicating something else excited. And there's a lot of fever around fear right now. Gold and dollar move together. So I want to see which one continues from Sunday's opening into Monday's trading. And how we close on Monday, I'll have more insights about that. And then I guess Monday I'll do a review again on YouTube, and then we'll revisit all these things that I've mentioned here and how it relates to, or if it's been negated by something else that takes place. Because again, anything can pop off and change everything I just outlined. But you have to have something in mind what you permit yourself to assume as risk. Because if you don't do that, you're just going to chase price. You're going to jump around from one model to the next, or one approach to the next, chase somebody else's opinion, whether it be my opinion, or fade something else. You're not going to know what you're doing. You're just going to be doing something for the sake of doing it, versus investing with a logic behind what it is you're doing, but also comfortably accepting the risk. So if I'm wrong, I'm accepting the fact that I'm wrong. If I take the trade based on the things I'm sharing, I'm okay being wrong in that case. It doesn't change my opinion about what I'm using to trade with. It doesn't hurt my feelings. I don't get mad and go out there and go raging. I'm just simply focusing on what I believe would be the best of the best for me going forward this week. And I just outlined that for you, okay? So let's just drop down to an hourly chart. Might as well just do a full run. All right. So I like the idea of the sell side here. You see how nice that is? It's real obvious sitting there like that. So at some point, I want to see us work below that this week, depending upon where we open up on Sunday. There's a little bit of a range there. It's not a lot. Actually, it's not much at all, really. That's forex. I'm thinking, I'm looking at futures. But that might be our initial draw. And then down here, I like that as well. So those are two levels I'd be looking for. I like how we went up, traded into this breaker. Here we have high, low, higher high, the down close candle, trade up into that with a SIBI. This candle here is a SIBI. Then we sold off, small little inefficiency. We traded up into that here, and I'd like to see it remain heavy with a dollar that doesn't want to go lower, and that would allow for euro to trade down into the sell side liquidity. If we do rally, there's a little bit of cleanness in here. You see how these are just a little too smooth for my liking? If dollar runs lower, say it sharply runs lower into that daily inefficiency outline for dollar, we could see the euro dollar come back up and wipe out this area here, because this would be trailed buy stops on shorts, and getting above these buy stops here goes right into this inefficiency right there. So for the dollar, I'm not going to go any lower than the dollar. I'm not going to go any lower than the hourly chart. I apologize. This area here are two premium arrays that are, if we see that drop in dollar, we'll see euro trade up into those levels there. So if you're going to be a scalper and you're not using what I'm outlining here and waiting for just that, if we get a drop in dollar, and you can see it trading towards that daily inefficiency, this is where the draw is on euro for the retracement idea. Even if it does this here, it doesn't upset the idea of what I've outlined earlier, because ultimately I think the dollar goes higher. So we could see it go up here, upset that, and then slowly drift down, and then later in the week aggressively run for sell side here, here, and then, you know, what we get after that's what we get. All right, so let's close this one, go over to cable real quick. If you're finding this helpful, insightful, I appreciate if you give it a thumbs up. That's just my little indication that you're receiving from me and not just wasting time talking about something. If you're getting some value from it, that's the report card you give me. That's our currency here. It doesn't cost you anything to do it. There's no PayPal required. So we have the inefficiency here on the weekly chart. We traded up into that last week. Let me actually go in a little bit more detail. Okay, so we have an old low in here. We traded up into that inefficiency and old low, traded up into it, and then we went right back down into this area here. So if we look at the consequent encroachment of that wick, or I guess it would be called the tail, we didn't quite get down into it. You see that? So I would want to see us go into this and have a close, same thing, just reverse it now. I want to see it close on a daily basis, because we're looking at a weekly chart. Look up in the upper left hand corner. This is the weekly time frame. I want to see a daily close below that 1.20, we'll call it 78 level. If it closes below that, then I would feel reasonably confident that we're going to take the low out here, and then look at these lows here. My eye jumps right to this and this, that and that. We have this already traded to, or almost right there, consequent encroachment. So it's this wick and this wick. So I look at those two as relative equal, and because we have undelivered consequent encroachment on this wick or tail, that is where I believe the draw would be on the downside. So we'll say this is it there, with the expectation that it would eventually pierce this wicks or consequent encroachment of this tail and then get into this inefficiency down here. So longer term cable, this is where I think we could potentially draw down to, because it can accelerate and over deliver versus and by comparison to what euro might do. So if the dollar does in fact go higher and euro goes lower, cable could accelerate and just really be animated to the downside and trade below the sell side here. And if it goes below here, how far can it go? It could reach down into this inefficiency of this fair value gap. But we're not talking about a day trade, okay? Because this is a weekly time frame. So it doesn't imply that just because you see something that's a short intraday, that intraday entry is a sound entry to ride all the way down there. I'm not implying that at all. I'm saying that for a long-term macro view of what may be in fact what we see over weeks and months, this is where the pound dollar could be reaching to. But initially we have to work out this area here where it has to close below the lower quadrant of this wick or tail. If it does that, what that tells me is this becomes likely to be in play, and the sell side resting below here. That would be my draw longer term, and I would submit to the idea that while it's still likely to reach there, and then euro maybe going lower and dollars going higher, I would believe that everything stays intact with that symmetry: dollar higher, euro lower, pound lower, but specifically aiming for pound moving, significantly lower, because it's tending to always, as its own characteristic, it tends to exaggerate the moves that would see euro go lower, pound dollar usually goes a little bit more. Just the same way you see the acceleration and exaggerated moves in NASDAQ versus the ES. It's just a natural characteristic that it has. All right, so with that, let's drop down into the daily. We're almost halfway there, folks. We're almost there. So we had the buy side taken here. And as I mentioned with the euro dollar, much in the same vein, this would have normally been a a breaker where we had a low, high, lower low. And if it was bearish for dollar, then this would have set up a bullish breaker. No necessity to trade down here at all because there really isn't a ideal fair value gap. There is one here, right in here, but that would have never been one for me to see as a shift in market structure and trade all the way back down into that level there. That's a little too deep of a retracement. I'm not a harmonics trader. I'm not a deep, 88% or 80%, whatever it is, a bat pattern or whatever it is. I don't subscribe to zoo patterns. So this would be treated by me if it were to trade below it, the same way I outlined it for euro. I would treat it as a inversion fair value gap. And I just did the wrong color. I had it right the first time. I like to use this color for inversions. That way, going forward, if you ever see it on my chart, it doesn't mean I'm always doing it correctly because sometimes, like I just did it here, I just did it wrong color. And especially if I'm doing a trade live and I'm trying to maintain my focus on what you're probably going to ask me or would ask me while I was doing the trade. And what I'm thinking as it's happening, my eyes go into these levels while I'm managing a trade. These are real trades. There's real risk here. These things have to be thought about at the time. And if I'm trading with a 15-second chart, that's a whole lot of identifying, calculating, weighing out whether this should happen, then thinking about what you're asking if you were standing next to me, or what you're going to probably ask me after I share the video of the execution, plus managing the entire trade and also coming up with a way of responding and highlighting and teaching while the trade's going on. I'm sorry, but that's just not easy to do. Okay, so sometimes I'll do the color wrong, but inversion fair value gaps, I'd like to keep this color scheme for it. Any fair value gap that I shade in a shade of like either green or blue, I'm treating it as something that would be considered discount for the purposes of maybe going higher. I'm treating it as it should act as support. Anything in a pink or red hue, that's usually something I would expect it to treat it as a resistance or some selling. Once it gets there, it should be met with some kind of a turn or maybe consolidate, but fail to go higher. And when it's orange like this, okay, that to me is signifying to you, and this is what I originally thought out when I first started teaching the inversion fair value gaps. This would be otherwise expected to treat it like this, like it did here. It went down to it, touched it, and rallied. That's reasonable. But because we're bearish on the pound dollar and we're bullish on the dollar, we would expect to see this trade through it and fail. Okay, so understanding the narrative, then you can anticipate seeing PD arrays that would in otherwise instances that would be, like as I mentioned before, if the dollar was bearish, trading back down to this level here would be considered a bullish scenario for pound dollar. But because I'm outlining and I started the analysis off with, I believe that ultimately we're going to go higher on the dollar index, trading back down here anyway, when we've already used it, not that it's a fresh zone, because it's not that, it's not supply and demand zone. I want to see it fail. I would expect it to trade through it. Now, if it does that, I would expect it to go back up, touch the low, respect the midpoint of it, not trade the entire range and touch the top of it. But if it does that and it starts to move lower, then I'm confident that we're going to blow below this low here. And then that means that I would expect a dollar considered bullish to be continued. And then any rallies in NASDAQ, I would treat them as a suspect rally and look to fade that. And any fair value got to go short, I would feel confident taking the short there. Now, do you see what I just did there? That's intermarket relationships. Okay, so intermarket relationships or intermarket analysis, using other markets to support an idea, not just simply looking at one pair or one market for the simple sake of, I see a pattern, I have time to trade, so let me just take a trade. That's too myopic. You have to blend a lot of things to get to what we considered, by my definition, high probability. Now, it doesn't mean that what I just outlined here is going to pan out. It just means that that's what I'm waiting for that would illustrate that this would be a high probability short for pound, and that means it would confirm continued upside, likely to see dollar going higher. Okay, so I've taken you through the whole spectrum of using other markets to support or what would negate the idea of me eventually taking trade in the only market I'm interested in right now, which is NASDAQ. But I gave you the criteria in which that you can study this going forward this week, see if it pans out, see if it offers anything to you, and then what patterns that you are looking for as your model, do they manifest later on in the week using this information? Okay, so it's an interactive study. It's something that it's explained in detail here There's finite parameters. It's not if it goes up or down, I'm right either way. I'm looking for higher dollar. But I'm also teaching how I will let and expect, because many of you, if you look around, have asked, how do you know when a fair value gap is not going to work? I'm outlining it here. But when it fails, it doesn't mean it's discarded. This means that I'm going to treat it as an inversion fair value gap. A fair value gap that fails in its function of bullishness or bearishness, if it fails, it will become an inversion fair value gap after it comes back to it. So there's no reason for you to be upset about taking a trade and getting stopped out if you try to use it as an entry to go long and it stops you out. You're going to get mad and think everything doesn't work because of that. When it should be, wow, okay, I got that wrong. All I got to do is sit back and wait. When it comes back up and hits it, I'll treat it as a shorting opportunity. And you'll get it back and probably more. And you won't wrestle with this idea that I got to be right. Because when we're wrong, it gives us insight. We just had to pay a premium for that insight. That's all. That's all it is. And that's how you wrestle through fear of missing out, fear of losing. Losing sometimes is going to cost money for you to get better perspective and a better insight. You're going to get a higher education because you paid for it. It's just like college. You're willing to pay for all those extra credits beyond grade school, rudimentary classes in regular elementary school. And then you go into debt to pay for that higher knowledge, that higher education. When you're a trader and you take a loss, it's the same thing. That transaction is you just paying for another class, and you paid for those credits. Now at the end of that credit or that semester or that course, you now have the insights that should have been gleaned from that exposure to that study of whatever it is, whether it be a class on mathematics or science or whatever it is, some prerequisite for your degree or major. You're paying for that insight. A loss in trading should be treated the same way. It should never be permitted to be catastrophic, where you're risking the entire access to your funded account, or it completely decimates your funded account combine, or it blows your account, or you lose $40,000 because you didn't use a stop loss on your live stream and you delete the stream and you pretend it never happened. Those things can be avoided if you do all these types of things. And you don't have these fear of being judged by other people or not judging yourself, because you're doing something that makes sense. You're doing things that are sound. There's logic behind it that's sound. You're not recklessly gambling. You're not afraid if you take a loss. You're not afraid your model's going to fail. You're not afraid that the only thing that you use to trade with isn't the right thing for you, because if the fair value gap is your PD array, if that's what you're using to trade buying and selling, you're going to meet a time where you expect these things to perform a specific manner or function, bullishness or bearishness. But when they fail, that gives you insight. That's what a inversion fair value gap is. That's what it is. It's inversion. You expected it to behave a specific way, but it goes through it. Well, here I'm anticipating price going through this very fair value gap here for the express purposes that it will hopefully provide a shorting opportunity that would accelerate further downside. And this becomes an inversion fair value gap if we trade down but not below this low before returning back to it, because that sell side's still there, and it would return back to this fair value gap because it would treat this as an inversion fair value gap. There's only buy side here on this candle passing through. We didn't get to it here. We went just shallow into it here, but from this candle's low to that candle's high, there's only buy side. It was delivered only here on buy side. So what is it missing? Sell side. So if it drops down, it offers that sell side to this candle's high. So it reprices to that range low, which is this candle's high. So that fair value gap has been repriced to offer the buy side that's been given here and then sell side. So if it moves away from it, comes back up, what is it going to act as? A balanced price range, which is the reason why I'm telling you that I would like to see it only trade to halfway. It can trade up to the highest point, but if it tells me, no, I'm not interested in going all the way up to the top of it after moving below it, if it hits the low and only stops at midpoint or just below it and then starts to move lower, that's exactly what I want, because it's signifying that the balanced price range is not permitting price to come all the way back up to the high of it. It need not do that. Why? Because we've already traded down to it a little bit in here. So we've already had sell side offered to that degree on that candle's low. If see, this is the part you don't want to hear. You want me to get to the nitty gritty and make it easy here to buy, sell, and expect it. But if you want to learn how to make money and consistently know what you're looking for, why am I using this candle? Why am I not doing this? And why am I expecting this range to stay unfilled? And why should I expect this one to be filled? Well, I'm teaching it to you, but it can't be done in a 5-minute video. If this candle didn't trade down into the upper portion of this fair value gap, if it didn't do that right there, then the one pass through it where I expect the fair value gap to fail here, not offer support, then I would treat the inversion fair value gap as it can go all the way to the high. Why? Because it wouldn't have had this drop down in the upper portion of this range. See that? But because it did that, it's already offered a measure of sell side. So between that candle's low, which I'll highlight here, what I'm saying is essentially is I don't want to see it trade above that blue line. If it trades down, worst case scenario, it can create a mohawk, which is a little tiny little deviation above or below a level that would be the level I'm looking for to be respected. But because markets are factoring a spread, and we all know Forex has a spread. I don't care what they tell you, what they offer you. Oh, I have spreads that are this and whatever. If the broker wants to expand it on you, they're going to expand it on you, and it is what it is. Unless you're using a limit order, if you're using a market order, chances are that spread isn't going to be what you actually get. And how often are you really checking to see what you paid in spread? You're not. You're just hoping to get in there because your fear of missing out is so high. That difference between this candle's low and the high of the fair value gap, which is this limit here. So I'm going to highlight both levels. I don't want to see price if it trades down below it. I don't want to see it trade back up in between these two levels once we get below this shaded area. Because the effects of this candle trading down to the upper portion of this fair value gap, it's already offered on the basis of this move here. That candle right there, that day, has already delivered most of the upper portion of what would be this fair value gap. So because it has done that, I don't want to see if we trade below it and then it comes back up and touches the low or halfway point. I want it to be sensitive there and not trade any higher. But it can create a small little mohawk just above that line there, but not touch the upper portion. If it does that, that tells me it's exceedingly weak, and then therefore I would expect dollar to accelerate higher. And then any shorts that I see in NASDAQ should be high probability. And then this should sell off pretty aggressive, reaching down for the sell side below over in here. But if this candle hadn't done this very thing here, that means that the only thing that this fair value gap has seen, again, this portion right here, imagine that's not there. Say this candle had a low up here. Okay, that means that this range only had buy side offered to this point here. So what's it missing? It's inefficient in sell side because it's buy side imbalance. That means its direction was a closing candle higher. The difference between the candle before it and the candle after it is that there's a little gap in between where the market has to eventually reprice lower. We're not down there yet. So when you look at a fair value gap, you have to see how was it treated, how was it utilized. It wasn't even touched here. I said that wrong. It wasn't willing to trade down the consequent encouragement here. It didn't come to the very low, that candle here. It didn't respect that. It traded just inside the upper portion or upper half of that gap that's created by this candle's high and that candle's low. So because it's done that, I don't want to see it once it trades back down below it. I don't want to see it come back up and touch the top. But if this wasn't the case here, then I would expect, and I would try to take a short higher up above the consequent encroachment of the fair value gap. And if I can get a mohawk right here on the high of it, or if it just pokes itself above it, many times you've seen me do, I'll add a partial and pyramid in that very thing right there. And you've seen people ask, like, why were you adding to it? It was outside the fair value gap. Because a mohawk is expected. It's permissible. We allow for it. I'm not scared of it. I know it's likely to occur. If I can get fortunate enough, notice I didn't say lucky, if I was fortunate enough to get the fill on that mohawk that just punches just above that, that's superior entry. That's part of the game I play when I'm trying to get fills. Like I want to try to do that sometimes. I'm not successful all the time because the market's gyrating all around, and hopefully I've made a major dent in your understanding about inversion fair value gaps here. I tuck it in to these these long-winded videos because these are the details. These are the details that, let me just make sure I didn't break my phone here. I told myself when I laid it on the armchair next to me, I'm probably going to drop it. And that's good. Just last until November 12th because I'm turning this son bitch off. So now you have insights. When do I expect a fair value gap to fill? Why would I expect it to fail? Why would I like to see things remain open? I covered all that right here. Okay. So in my book, when I talk about inversion fair value gaps, I'm going to cite this very video where I walk you through the explanation with an example, because everything I just said in text, you might read it and say, I don't understand what he's saying. But now you've seen me outline it. You've seen me refer to it here. And every example where I've ever shown the trade where I've used it and you watch me call an inversion fair value gap before the market itself respected it as such, now you understand the dynamic of what I trusted at the time. Because it's not make-believe and it's not hindsight. It's logic that's being referred to on an ongoing basis that will tend to repeat more times than it will fail. And then in and of itself, that is an edge. That's a model. That's something you can put statistics and probabilities behind. And if you can determine when the market's predisposed to go higher or lower, that by definition gives you high probability. And if you can't do your trades with that mindset behind each and every one of them, you're gambling. You have no idea what you're doing. You're just hoping and praying. And when it's right, you'll call it skill. When it's wrong, you'll blame me. You'll blame the methodology. You'll blame the broker. You'll blame the market. You'll blame everything else but yourself. So this discussion is just reverting back to you as the responsible party. When you do it wrong, you did it wrong. Everything else is exactly what it is. It's separate from you. These gaps don't make you buy them. They don't make you short them. You decide that you make that decision. So I'll move on because I could go on a lecture about that. So let's go into the 60-minute chart. All right, and same thing here. We had a SIBI breaker. We traded up into both of those. That is a very, very strong model when you're looking for sell side. Everything reversed, you can use it for when you're looking for buy side. It broke lower. We traded up into the inefficiency here. And this is one of those things that I got burned many times on Sundays where I had this very scenario here, where it looks like, okay, we traded up into that. And if we opened up inside this fair value gap here, I would go short right there on Sunday and expect Sunday going into Monday, London, it would just trade lower. And it wouldn't do that. Sometimes it would go higher, take the buy side that I would be treating as my stop, and totally, prevent me from being profitable for that Sunday's trading. It was this very thing here that caused me to stop trading on Sundays, where I used to take trades on Sunday. When we would open up, I would trade, the first 3 hours or so of Sunday, and then pack it up going in around 10 o'clock. You do whatever I normally do if I'm going to nap or whatnot before London session, or if I went to sleep, that's what I would do. And then come back in London and see if everything was in the same vein of what I had hoped for. And if it gave me a trade, I would trade in the London session. But because of all the things that's going on that I've talked about in the early portion of the video or the live stream here that you're all listening to, the wartime events, the terrorist events, the uncertainty and the likelihood of it happening in all of our backyards, all that stuff could promote enough fear, and they might want to to start revving that fear up by having a gap opening lower, then come up, reprice to close the gap between where we closed on Friday and where we open up here today, later today at Sunday. Close that gap and then go lower. And then I'd like to see it trade below that gap and not offer support. I want to see it fail. What happens if it trades down to this? It treats it as support and rallies back up. I won't be long. I'm not trading Forex, but you shouldn't be upset about that, because what you're going to be treating it as is what? Inversion fair value gap. There's always going to be moves that take place that you didn't see coming. But here's the wonderful thing. You didn't lose money. You're going to beat yourself up about how much you could have made if you just would have took that trade, but you didn't see it coming. So how are you going to punish yourself like that? You're wasting mental capital doing that. You're literally causing mental drawdown on money that you never really risked, and you can't make money thinking and worrying about it. So by having these pre-market opening expectations and running scenarios that would allow you to feel comfortable taking a trade, and what you would be comfortable letting go without you being a participant in, it helps free up that, well, permission to give yourself, so that way you don't feel impulsive to chase price. Because you can see it trade down in that fair value gap and it starts to come up a little bit, and you're thinking, oh man, ICT's probably got it wrong. What if it does run, 100 pips higher? That's 100 pips that I could make, and I can come back and say, ICT, I faded what you did, and haha, I feel great. Wonderful. If it happened, it would be great. But are you going to feel comfortable in the trade? Probably not. You're going to be hoping and praying that it works out. And you won't be looking at what the market's telling you while you're in it that might tell you it's going to fail, and then do what I'm outlining here, which is trade below this gap. So there's a lot of different ways you can use what I'm telling you and what I'm explaining. Okay, all I'm saying is just be responsible with whatever it is that you're doing. You own it. If you make money with it, you did it on your own. If you lose money, eat it. All right, so let's go over to S&P. Get through these real quick here now, because I am getting hungry, and you're probably gonna start hearing my stomach growling. I don't eat the crepes. I tweeted about that this morning. I make breakfast for my wife. She likes to have that stuff. I just had oatmeal. All right, so here's the weekly chart. Here we had the market rally up in recent months. We were expecting the market to trade up in these levels, and then I gave you an outline for a bearish scenario looking for a quarterly shift. That means every 3 to 4 months there's going to be a shift in market structure where the market can move sustained moves for 2 to 3 months, but as long as 4 months, because there's a little bit of an overlap where it's not running on a perfect 3-month calendar. Just because we say quarterly, that is not broken up equally into every 3 months. It can go a little bit past 3 months, and it could be as short as a price run of 2 months. All I'm stating is when I'm looking at higher time frame weekly and daily charts, I'm looking at how we could, for the next series of up to 2 to 4 months, where could it be reaching for? And I have these levels in mind, and I have them written on my pad. Okay, so my little notepad has higher time frame monthly, weekly, 4-hour levels. And they are very significant draws on liquidity for me and my trades. So if I think that there's going to be a draw to a very low level, like for instance, say 4,200, not that 4,200 is one, but for the sake of discussion here, say 4,200 is a level that I felt is something of importance, and that we could reach down here on a longer term basis. Any trades that I would be taking that's short, and if we get within, I don't know, 20 to 30 handles, I would likely be at my maximum risk, which is 5%. If I'm taking trades that would be moving away from my monthly, the weekly, daily, and or 4-hour levels, I'm not going to trade with 5%. I'm going to trade with like 1.5% maximum leverage. So the benefit of having all these higher time frame levels is to know when you're going to push the envelope of your risk. If it's more likely to pan out and go into these higher time frame levels, then I'm confident that my intraday trade executions are very, very tight. They're very specific. They're very extremely precise. I know what I'm looking for. I know when they're going to likely form. And if I can frame them on the basis of moving in the direction and it starts getting real close to these higher time frame levels, then I'm going to go with my maximum risk, which is 5%. Okay, that's how I ran up those MT4 accounts. Okay, when you saw me run those things up, I was doing every single time I took an entry, I was using 5%. Every new partial or every new pyramid entry, in and of itself, that new entry was 5% risk. So some of those trades would have as much as a 20% impact on that account. But when you're running it and you're getting hundreds of pips, it parlays it up fast. It's math. That's all it is. It's not a rented MT4 server. It's not Photoshop. Sorry. Anyway, no extra charge. So we went up into this SIBI here after working into a old low. So trading up into that. Can we revisit this high? I'd prefer that it didn't. So I would like to see it stay. I would like to see it stay in the lower portion of this wick. Okay. So I would like to see, if we have any kind of rally up this week, I want to really see it stay below the 43.91 level. So I'm expecting a little bit of movement around in there. It can start to gyrate towards that direction. I don't want to see a close above 43.91. I don't want to see that, not on a daily basis, because if it does that, then it means we're probably gonna have to run this high again and maybe work up inside this area where the volume imbalance is residing. I like the fact that we didn't get up to the volume imbalance, because that to me indicates that it's heavy. It didn't want to close in all of the SIBI, which is a big down close candle, and it didn't even want to get back to the volume imbalance. So there's two factors that would be constituting a premium in the range of this high to where we made that low. So we were unable to get to the volume imbalance, which would be here. So your chart would look like this. When we rallied up last week, we did not get to this volume imbalance, and we left all the portion here open. This is the sell side imbalance, buy side efficiency low, and it's the high of it. So it would look like this, shaded. If you're learning, you can hit that like button. It would be a great appreciation by me. And we didn't get the consequent encroachment of the SIBI. So what does that mean? There's three things that would be normally viewed by me as a premium array. We couldn't get there to any of them. So that's nice. So when I see that, the logic is, okay, we have this big wick. So now, because we have that wick here, I don't want to see it trade above the halfway point of it. I want to see any retracement back up be maintained and held within this range here. There. I'll take this off so that way you can see it. So any movement to the upside, I want it to be limited to good grief. There you go. To inside that range. Okay. And that is 43.91, nothing higher than, and in between where we closed here. So it can do anything it wants in here. I just don't want to see it go above here on a closing base on the daily chart. As long as it does that, I'll remain bearish for ES and bullish on dollar. So you see how I've taken all the markets together and put them together like a puzzle piece. That doesn't imply or ensure that I'm going to be correct, but I'm telling you how I teach, how I use these PD arrays, how I'm using intermarket relationships, how I'm factoring in this geopolitical and wartime event where it creates a great deal of difficulty because you don't know what's going to happen next. You don't know what responses are going to be by different nations and countries. And you don't know when it's going to pop off in your neighborhood. And all that stuff creates a great deal of interest in the market to speed up and rev up fear. So because we're in this condition and we're in the final quarter of the year, any animation in price is going to be exaggerated. It's going to be exaggerated. It's going to move a whole lot more. Your targets, they're going to be easily met, but they're going to be probably blown out, and they'll go way past them. And you'll see them probably go to levels that I can't perfectly go to a methodology and says, okay, this is what it reached for. It just goes beyond them. That's how you know that they're utilizing fear. That's manual intervention. But if you are looking at instances where we can still take trades and be acceptable of the risk that's involved around them, weighing out the risks and still allowing for the best case scenario where we get the best of the best. So when you have a trade target, these are the conditions where you want to go and say, okay, this is where I want to get out at. This is the perfect exit. You want to have 80% of your trade taken off before that, but leave something on to go past your best case scenario exit. That's the kind of climate we're in. You don't see that in books, and it's hard to articulate the reasons why and when you would trade like that unless you're in these environments, which is exactly what I taught in my mentorship. That's mentoring. You're watching things and understanding the logic when I'm explaining something. And I sound very verbose about a lot of things that may not seem like it's all that impactful to you or useful to you. But for someone that's been trading for a while, that has made money and knows what it's like to be in conditions where they just didn't feel like they were dialed in or knew what they were looking for, or something surprised them. I'm not usually surprised by very many things. I'm not. It doesn't mean I'm right all the time. It just means I'm not surprised. And I know that the climate that we're in right now, certain characteristics tends to manifest itself in a way that I'm describing here in this lecture today. Any other time when we don't have the wartime events, we don't have the potential of terrorism popping off everywhere, then no, then I wouldn't expect this. It would be, here's the best case scenario target. I'll still get out at 80, and I will go one tick or two below what I think it's ultimately trying to reach for, and I'll be satisfied if I get that. That's a normal functioning methodology for me, because my weaknesses are my exits. I want them to be perfect, but I have not been able to be perfect consistently in a manner where, if you look at by contrast where my entries are, they can be deemed phenomenal. But my exits, I'm not satisfied, because I'm using multiple time frames many times to ascertain what those targets may be, and I don't know which one at the time I feel comfortable settling with. And if I'm watching multiple time frames, if I'm teaching while taking the trade, if my son's sitting next to me and he's asking questions because he's impulsive, he's a young guy, that might change my mind about something, because now I'm going to be thinking about what he asked me, and I was willing to submit to this target, but now I'm wondering what he's thinking about. So can I think about my trade objectively? If my heart's interest is to try to get my son to learn how to trade, he's asked a question. Now I'm going to try to think about how I can better answer him. So my focus is now broken. So there's a lot of things that takes place when you're trading. And if you're trading with real money, these decisions are heavier, not just going in there and watching a tape read, or you're not really pushing a demo, you're not really trading with a combine, you're not trading with a funded account, you're trading with real money. And when you're at least I can only speak this from my personal perspective. Once my concentration's broken, I'm done. Like I have to close the trade, because what will happen is my bipolarism will kick in, and then what will happen is my rage will take over the management of the trade. And that's what has hurt me when I was in my younger years. That's the very thing that would take place, and I wasn't able to identify it. So whenever I lose focus, whenever that is, and whatever the catalyst was that causes me to lose focus, I have to take myself out of the trade. And if it goes to my targets that would have been filled if I would have stayed in a trade, or if it goes way beyond it, I've just grown to accept the fact that I can be imperfect but profitable. And it's a very forgiving state of mind. And that's what I try to teach you. I try to teach you to have a low-hanging fruit objective. And over years, not a week, not a couple months, not just the first year or two, over years, you will get better and refining it. And one of you, as my students, are going to come up with an amazing exit strategy that is uniform. This is what you do all every single time. You're going to use this method, and you'll get this high degree of accuracy. I hope I live long enough to see it. I'm confident that that's what's going to happen. I've given enough resources and ideas for some of you, if not one of you. You're going to come forward and say, this is what I found out that works for me. And I might end up utilizing it for myself. And I would be open up front and say, this is exactly what I was looking for, and you found it for me. That would be wonderful. I would love to be able to do that. But until that happens, I wrestle with imperfections in terms of what I'm comfortable with settling with a target. So anyway, I just tossed it in there because I felt like it needed to happen. Daily chart on ES. Yeah, we don't want to see it trade above here on a closing basis. So we'll get this off here. All right, so there is no inefficiencies in this run here, but we did do what? Look real close. I'm not going to say anything. I want you to look at it. We have just crossed over something that might be impactful going forward. Had to sneak a drink. If you look at this candle's high, this candle's low. All right, now let's play devil's advocate for a moment, okay? Say we gap down at the opening. We have a gap lower opening, and then we trade back up to here. I would like to see this trade just to the low, not trade to the top, be permissible to trade to the midpoint because this is a fair value gap. If we're bullish, this would be expected to offer what? Support and send price higher. But if we're bearish, what would we expect to see this do? Fail. And this is what happens when jokers literally look at things and they talk about something that I didn't talk about. But they'll point to a chart and say, look at this. This is ICT stuff failing. In your hands, it's failing because you don't know how to use it. But in the hands of someone that's proficient, and especially the person that's created it, I'm telling you how I'm using it. This fair value gap fails, and it gives you insight. Now, if everything were to happen, so we have a gap lower opening. Say we gap lower than this candle's low. Okay, we gap lower than Friday's low. It can trade back up to this fair value gap's low, have a mohawk that could reach to consequent encroachment. I prefer it didn't do that. It can go to the low and maybe a tick or two above it and not trade to consequent encroachment, and certainly not trade to the upper portion of it. Why? Why would I say that here? Because we have had this candle go completely through and below it. Look real here. Look real closer here. You are getting a PhD level in terms of price delivery today. No charge. See how we ran through this gap here? This whole candle here went all the way to the high of the gap, which is this candle's low, to and through the low of the gap, which is this candle's high, and we create a little tiny little mohawk right there, colored outside the lines. That's completely permissible. That's acceptable. We are not afraid of that. Then this candle here, we trade down through it entirely. So now what did we do? Did we have any respect of this gap? Nope. Is that a bad thing? No. That means now if I get an extreme gap opening because it's the weekend, we don't know where we're going to open up on Sunday. If we open below this low, we're really technically oversold. We don't even care to tell us that. We're really oversold, and then they'll reprice against the opening price because everybody's going to want to do what? Chase it lower. Think it broke out to the downside. So they'll enter right away because the market started opening up and it's trading. So now it's time to get out there and race and chase after investment profits. Let's just get out there and go do something. It's the weekend. I ain't working. Let me go out and just do a trade. And it runs back up and touches the low of that fair value gap. I would like to see it do that and then roll over and go lower. Aiming for this day's low. Why? Because it's a daily low. And then see if it can gravitate towards the sell side resting below here throughout the week. It may not happen this week, but gravitating towards this area down here eventually. But treating this as a premium array and expecting it not to need to trade to the higher end of it. Now, how do you use that information? If you're going to use this as a mechanism to get short, your stop losses can be limited to consequent encroachment and just a little bit above it. Now, what's a little bit above it? It would have to be, in my opinion, at least 3 to 4 handles above consequent encroachment. Because remember, we allow for what? Little mohawks, a little coloring outside the lines. And if you're too demanding and you want to have these 1.5 handle stop losses, which you can do on the lower time frames like the 15-second, 30-second, 1-minute charts, you can do that. But I wouldn't try to do that in the climate that we have right now, because there's a whole lot of they've sped up things where it tends to be a little bit more exaggerated. Even when it's not moving much, it's still moving more than you're going to be comfortable doing with a less than 2 handle stop loss. It's just you're asking that it get stopped out. And are you going to have the experience to see that the trade's still there and you were just being too greedy and too tight with your stop loss to get right back in? Chances are probably not. Where I can be stopped out, and you've seen me do it, I think 3 or 4 times this year. I'm trading with real money, live money, not demo, real money, getting stopped out and immediately going right back in and getting what I wanted to take down as a haul. So that's experience. But you can't understand these things. If I was to teach it through a book, just only through a book with a static chart and then showing you after the fact, here's what it looks like, it wouldn't mean as much. You wouldn't be able to take from it the very impact that I'm trying to put forward in this discussion today. So seeing specific PD arrays, and it's not just simply a fair value gap that fails. There's many times I want PD arrays to fail. Think about when I'm teaching you order flow. And I'm talking real order flow. Real institutional order flow has nothing to do with level 2 data. It has nothing to do with a DOM, depth of market. It has nothing to do with volume profile. It has nothing to do with any of that gimmick. It has nothing literally to do with that. It's literally how every candle supports price. As it's going higher, every down close candle. In that down close candle, algorithmic buying is taking place. So it goes without saying, when it goes above that and it comes back down and touches it, it's not going to need to go back down in there because the algorithm has already extended the opportunity for the algorithms that use this in a marriage, like a handshaking between the delivery mechanism, the price engines that cause the fluctuations in price, and then the algorithms that can handshake with it, like my enigma, that my conceptual idea of how to handshake with the market's algorithm. They dovetail perfectly together. That's what makes my stuff precise. That's what gives me the confidence to share things on Twitter before it happens, and you watch it happen in your chart every single week. For years now, 2 years you've watched it. Where my private mentorship, they've watched it for years. Years, daily, every single day. This is what I think is going to happen. And over time, you get comfortable with it. But when we see down close candles supporting price, what are we looking forward to on the opposite spectrum? When we're bullish on price, we want to see down close candles support price because they're acting as what? Bullish order blocks. But we want to see bullish candles on the other side, on the left side, that would be considered what? Bearish order blocks. As price was going lower, every up close candle should have offered what? Downside delivery, sell side delivery, moving lower. So we want to see price going through with ease up through them. That's real institutional order flow. There's no depth of market necessary. There's no fake ladders and spoofing that can occur in that. It's finite. It's in your chart. You can see it. Everybody has the highest high and the lowest low of every one of these candlesticks. Everybody that's looking at the NASDAQ futures contract, the same delivery contract month of December 2023, we all have the same high and low on that candle right there. There's no discrepancy. We all have that. We can see it. It's right there, okay? You can't do that with Forex because everybody has their own Tom, Dick, and Harry spreads. And that's how it's not the gentleman's choice of markets. It was great when it was wild and woolly, and that's why I left futures to go over there because there was a lot of excitement, and I knew I could do very well in short little time frames and capture big movements. But now we've had a little bit different dynamic, so I want to go back to what I trusted and where I started in 1992, which is the commodity and futures markets. And they're going to be much more precise and more refined. You're not going to see a whole lot of tomfoolery in it. It's very, very specific. You can make a career out of these one individual markets and not have to look at anything else. You got to figure out which Forex pair to worry about. No interest rate differentials to worry about. It's just, are we bullish or are we bearish? And where are we looking to go? Real simple. You can have a very short work life too, with 1 hour a day and you're done. And it's consistent. But when we look at PD arrays, and I was using the institutional order flow as an example, my point when saying all that was, when we're bullish, every down close candle should support price. Every time it touches it or goes into it, it should start repelling and setting price higher. And price should spool higher after doing so. If we have met a range extreme, or we traded to buy side liquidity that would constitute a potential reversal, while order flow has been bullish and we've maybe capitalized on that, now if we have seen a run on buy side and then it broke market structure and then rallied up and gave you a 2022 short entry, what do you think you would be expecting as the price is dropping down? Every one of those down close candles that supported price going up, you want to see price eat through that quickly with no hesitation. You want to see those down close candles when in the hands of anyone else, they're going to think that that's a bullish order block because they think every down close candle is an order block. And it's not. It's not. There's a narrative at work that you have to know what that is to make the order block be what you expect it to be in terms of a catalyst to be an entry or a target. Hello. So every PD array has in its formation a application of wanting to see it fail for the purposes of giving you insight, then you can use it for a counter trade idea. It has an inverse nature to it. So when you see price like this and you finally, and what I just said, for some of you that are brand new, you don't know what I'm talking about and you don't really appreciate what I just said. But for students that have been with me for a long time, they just had a light bulb moment because now all of a sudden they're like, wow, I don't have to worry about my model in the PD array like the breaker. If it fails, I can have an inversion and trade off of that. If I use a mitigation block and it fails, okay, when it trades back to it again, I can trade it inverse and capitalize even with half the leverage and get back what I lost and still find a profit. So there's no reason for you to fear or try to avoid losing because you're going to lose. You're going to have a losing trade. You will absolutely have a losing trade and probably have a series of them, especially when you're brand new. But there's nothing to fear. There's no reason for you to fear that because your ability to judge and pick the very specific entry points and measure the risk that's appropriate for you from your entry to where your risk is, that's a skill set that's going to take you a while to figure that out. I have rules that help you do that, but you still, like I talked about the Twitter space yesterday on my Twitter feed, I talked about where motivation becomes impulse. You have all these good intentions of going in and looking at the chart and maybe doing something that is highly organized and specific and disciplined. But when you get there and you're the excitement of maybe potentially missing it and then second guessing yourself and you think, well, what if my model isn't there, but I do see it moving up here and I think it's really going to go up above that old high or below that old low. And you completely abandon the model and you trade recklessly and impulsively. You won't do those things when you start seeing that this dynamic that is in price action. These things repeat all the time. They repeat all the time. And when your model fails you, based on whatever PD array that is that you're using as an instrument for entry, whenever that fails, just know that there's one of my students that were looking for that very PD array to fail because their model is returning back to it and then using that. Never looked at it like that way, have you? But that's exactly what some of my students do. They're not breaking the models. They're not trading outside of what I taught. They're just using it in a model that fits their expectations on price at that given time. And it may not be an inversion fair value gap that you use as your model, but it gives you the flexibility to say, okay, I use fair value gaps to enter. But if I get it wrong, that means it's probably indicating that I'm really offside. So if it comes back up and trades back up into this level here, it might offer some measure of resistance. So therefore, we could see an opportunity for it to trade. And where would it trade to? Here's a daily low right there. What could you use as a partial before you get to that? Half of this range, which is what? right here, which will be right below Friday's low, the opening of that candle, and the consequent encroachment of the wick. Do you have to take a partial at every single one of them? No. Which one would make sense for you based on how much you're leveraging, where you got in at, where the entry was? Because it could trade up to here and break extremely hard, and then the only first fair value gap it gives you would be, down in here that you would feel comfortable taking. And there's a lot of things that you have to weigh out. And unfortunately, there isn't this always easy 1, 2, 3 criteria or recipe where it always does the same thing at the same manner, the same range in pips of risk, the same pips in terms of the profit, and every profit partial should be only this many pips away from where you got it. You can't do it that way and be consistently uniform. I wish it was like that, and I was trying very hard as a young man to make trading like that. And I've come to the conclusion it's not necessary. That's something that will evade you. That's perfection, and perfection's not necessary in profitable trading. That's an epiphany that once you get that, you don't have to be perfect to be profitable and to be content in that profitability, not thinking I didn't get enough, which is why I always preach what? Be content with enough. Do you have more money today than you had at the start of the day? If you do, stop. Go home in profit. Get used to feeling that. Who cares if it's only $50? Who cares if you just you covered the cost and commissions and you're not in a net loss for the day? We can go home and feel what that feels like and grow comfortable saying, you know what? I didn't lose money today. Your first goal is to stay as a break-even trader because most people go right out the gate, go straight down and lose. You don't want to do that. You want to be able to maintain that watermark of where you opened up your equity, that balance. You want to stay real close to that until you figure out who you are and what you're trying to trade with. You're going to discover a whole lot about yourself when you start trading with real money. When there's real risk, you're going to decide whether or not you can trade with that model, with that time frame, with that measure of risk, that number of handles or pips that you're trying to use as a stop loss. It might not be feasible. You might need to trade with a larger stop loss because your precision isn't there yet. And that's not a knock against you. That's not saying that you can't be more precise with smaller stop losses eventually. But so many of my students try so quickly to try to rush to these really small little tiny stop losses, like that somehow makes you superior to someone else. It's not, because the chances of you getting stopped out exponentially increase. It demands precision that you may not have yet. Whereas someone that's brand new and they offer themselves a 15 handle stop loss, that sounds like a lot. It is if you're trading with 5 or 15 contracts on a mini for S&P or NASDAQ. That is a lot. But you're not going to feel that way if you're trading with one micro lot. It's not going to be that much. And you have to learn how to manage yourself. You have to learn how to hold on to these trades and not freak out and be in a rush to get your stop to break even or profitable. That's an entirely different lesson you have to learn too. That can't be taught in a book. I can't teach you a lesson that makes you feel comfortable doing it. You have to follow the rules I've provided and then do it. And you'll discover, okay, I need more time doing this with a lot less leverage. And which is why I tell you go down with the micro. $5 per handle for the E-mini S&P and $2 per handle on the NASDAQ. That's not a lot of money, but you can still make money doing that and learning how to get good at it. So many of you get these funded accounts, like my son. He can get these funded accounts. He's made money with it, and he ran in there and tried to do a $150,000 account and dusted it quickly because he went back to doing big contracts again because he thought, well, all I got to do is replicate what I did there with more contracts. And he found out he can't do it. The fluctuations of the money scares him. So if he's scared of the money, is he going to think about the trade, hold it correctly? No. 2 ticks or 3 ticks of movement against him, it scares him out of the trade. He closes it in a loss, and then it runs in where he's thinking it's going to go. And he does that multiple times. And eventually he hits the maximum loss, and then that 150 count is gone. He did that with 2 of them this week. You're not obligated to know that. But I'm telling you, just because he's my son, He's doing the same things that some of you probably are doing right now because you're impulsively trying to do things that you're not really ready to do with an amount of risk that's too high for you. You have to graduate into that. I don't know why I even brought that all that up, but just know that the stop losses, I would like to keep the stop loss tight here at just above consequent encroachment if it was a trade up to that level there. And if I got stopped out, it's okay because I'm following the rules of what I've outlined here. But because we've overlapped it and we went from the highest point, the consequent encroachment of the fair value gap, and the low, and went beyond it, and we closed below it here, if we open below this low and trade back up to that level there, I would expect it to act as resistance. And it could only, in my opinion, be high probability if it stayed below consequent encroachment or just one tick above it. And I would not want to see it trade to the high end of it and still act as an inversion fair value gap to offer lower prices. That's how I'm framing it, so you know what I'm looking at, why I'm even factoring any interest around these specific levels. So now, because if we have something that forms and I point to something, whether it be hindsight, after the fact, throughout the week, you know that I've outlined the very things here. And if it doesn't work, it's great. You'll get to see what it's like to be here before the market opens up on a Sunday, where everything is completely random. You don't know where that opening price is going to be, and factoring all the other things I've talked about that's going on in the world that makes things a little bit more complicated and complex than it normally is. But you can still find opportunities, and this is how I would frame this for S&P. So 60-minute chart. What I just covered there, that would have been a charter level lesson. Only people that would have been at the charter level, and if other people were going through mentorship and haven't got to that point of being charter, they never would have heard that lesson. That would have only been for a charter member student. They just learned something that they just learned for the first time. Stop buying into people's mentorship saying that they're teaching something that I'm hiding away in some other chat room area. I'm not doing that. I'm not making videos for anyone because they're going to take them and sell them. I'm not creating a market for them, okay? So I just want you to understand that. All right, so this drop down outside of that gap closed in this portion of this buy side about sell side inefficiency. And if you look over here, this is a little too clean. And there's a gap right underneath it. So if you look at that, I like this. This inefficiency now has been repriced to with the movement to here. So that gap is only this candle's low to this candle's high. So that you would extend that to the right. And you thought I was just buying moving average crossovers. I did too. And it might seem like it's very, very complex right now, and it will be as a first introduction to it. But over time, seeing it utilized and referring back to the same logic, and it repeats. Every single week, it's the same stuff. So we have inefficiency below price, and we have the sell side below this low. That would be the draw should we move lower. If we move lower and then come back up and use this area here, and we haven't traded into the fair value gap down here, that would be from this level of the daily inversion fair value gap to as much as the midpoint, which is consequent encroachment. From those two levels there, or anything between it, trading down into that fair value gap, that would be a setup that I would like to trade this week. I would like to do that for ES. If it offers it to me, I will try to do it. And if I can manage to finesse it, or if I'm available in front of the charts when it was to happen, I'll record myself doing it, and it will be with a live account, so you can see it's real money, and you'll see that this is what I tried to do. I talked about it as a scenario, and this is what it looks like. Okay, you'll see a real stop loss. I don't trade without a stop loss like a maniac that thinks he's always right and then loses his ass in front of everybody on the live stream. Okay, I'm not trying to present perfection, but I'm trying to select very specific things that I feel are high probability, and I'm trying to engage them. That's what I talk about on Twitter. When I point to something, I have already come to the conclusion within myself that this is something that I think has high merit. It's worth mentioning. It means I feel confident that I'm probably not going to be wrong. There isn't a lot of times where I point to something, and there is even less instances where I talked about something on Twitter and it not pan out. The point of that is, how many times have I done that? It's not every single day, because every day is not everyday trading. Day trading is not everyday trading. In the beginning, you want it to be. You want to find an opportunity to do something every single day because you're excited. You want to make money. You think there's an opportunity for you as a brand new student, brand new participant in trading. You think that that's something that's realistic, and it's not. That's not. Someone that's versed in trading and understands price action, understands their model, and understands themselves, yeah, they can do that. They can have an everyday profitable experience. Might be met with some losing trades in intraday, but if they really know what they're doing, they can come out of that losing day, net loss day, and come back and cover costs and be very even, or maybe eke out a small profit. Or if you're really, really good and the opportunities present themselves in the afternoon, in the last hour of trading, you could find yourself from a net loss day in the morning half, get back to break even on the PM session, and somehow find your way into profitability on the final hour trading. But that type of trading isn't what a neophyte or a new student should expect. You shouldn't expect to be able to do that in your first year of trading. And I'm being 100% practical and honest with you. Some of you have expectations placed upon yourself that are not realistic. And when you don't hit them, or you're able to, or not able to be able to do that in your trades, you feel that you're a failure. And it causes you to be impulsive and reckless. And then you do things that are outside your model because you're angry at yourself and you resent yourself. So you inflict punishment, but what you're really doing is, in your mind, you're justifying why you're punishing yourself, but you're calling it punishing the market. I'm coming back with revenge. I'm going to take something from you. But really, subconsciously, what you're doing is you want to lose because you want to stop doing what you can't control yourself from doing. That's what a gambler does. I talked about this yesterday too. Gamblers, at some point, they get to this, it's called gambler's numbness, where you just bet for the purpose of just, you want to lose, so that way you have nothing left to do because you can't control yourself. You can't get away from the table. You can't get away from the slot machine, the one-armed bandit, the jackpot machine that everybody that puts the money in, the poor man's casino's game. At some point, a gambler, whether they're trading or whether they're playing cards or at the casino, without seeing profitability, frustration kicks in. And normal person would say, okay, let me just cut my losses here and go have a dinner or watch a show and come back and try to do it tomorrow and see what I can get with it there. That would be mature. That would be someone with a good steward mindset with the money that they have in their hands. But most people that go to casinos don't have that. So what will happen is they'll keep gambling until they get to this point that's called gambler's numbness, where you don't care if you lose everything. In fact, subconsciously, that's exactly what you want, because your inability to leave the risk, to leave the losing, and get back to a sound mind, you're incapable of doing it. So you start offering the opportunity for everything that you have to be lost, which is the reason for you to stop, because you don't have a mechanism to stop yourself. That means you're undisciplined. And many of you probably have experienced that. Right now, you can look back and think, wow, that's exactly what I was doing. I never looked at it that way. But you're doomed to repeat it unless you identify that's exactly what it is. And if you get to the point where you're just pushing the button for the sake of pushing the button, you need to immediately get out of that trade, preserve what you have left, take the rest of the week off, period. There's no discussion about it. Don't look at my tweets. Don't watch my videos. Don't talk about trading. Don't look at charts. Stop for a week. You have to ground yourself. It's really important that you understand that that is something that will wreck you. And I see people that have been trading for a long time and they still do it. They can make money here and there, but they're not consistently profitable. They're not millionaires in trading, despite saying that they are. They fail consistently trying to do something that's outside their potential or outside their skill set. And they're gambling with the one chance that they might be able to pull it off, and then hoping that the public sees this and thinks that that's what they do all the time, when they don't. That's just an aberration. It's just one-time event. And they're treating their trading, over leveraging, doing more contracts than they can reasonably handle without a stop loss, because they want it to be right so that way they can champion this whole thing. And that's not what trading should be. It should be about picking very specific entry points, having very controlled risk that's reasonable, and a profit objective that is handsome enough to know that it's worth taking that risk. And the precision of entry around the logic and the narrative of why that trade should be performing that manner, why price should deliver that way, where it should go, why should it reach for that objective. It can't be just milly-nilly and some Mickey Mouse logic. It has to be something of substance that's outside of retail logic. Because if it's retail logic, that's flawed. It has to be on the basis of a purpose of running for liquidity or rebalancing and repricing to an old inefficiency. That's the only two things that causes prices to go up or down. Apart from that, it's manual intervention, and you can't time manual intervention. You can expect it a specific week around calendar events. The economic calendar has a lot of big news reports or speeches, or the Fed chair comes out. Okay, yeah, manual intervention is likely to occur at that time and around that day. But there are other instances where manual intervention can come in and completely surprise everybody with an explosive price move that was exaggerated well beyond what would be reasonably expected. And if you're offside in that event, that's risk that you didn't foresee when you first started trading. And I'm trying to be practical and reminding all of you that's always looming. And it's really looming in Forex right now. So I just want to make sure you understand that. All right, let's finish this up so I can hear my wife down there banging the dishes around. She's letting me know she's getting frustrated. I'm on my way, baby. So we traded up, made a high here. We broke lower, had a shift in market structure, came back up to a bearish order block, rotated lower, took out another sell side liquidity pull here. Just got inside. If you remember, I said I wanted to see it trade down into here. Go back and look at the old reviews on this YouTube channel. They're all time and date stamped. I can't time travel and go back and edit them. All right, so let's take this off here. So we went down in below that low here. It was a little too shallow for my liking. There is a gap. We traded up into that. The consequent encroachment of this wick, we'll highlight that. Okay, so we went above that just a little bit, Mohawk, then rejected there. So we did the effects of repricing to the fair value gap. That's this candle's low, this candle's high. So we repriced there, went up to the consequent encroachment of that wick, which is reasonable, it's expected. And we did bump the buy side above this short-term high. So those are all things I talked about on the hourly chart. When we get down to the hour chart, I'll show you what I mean in specific terms. But we went above there, and then we offered what? Sell side delivery, went lower. So now we have a couple things to look at on the downside. Should the equities move lower, these are the levels I'm going to be using going forward for this week. Consequent encroachment of this tail of this candle. I'm going to take this off, okay? So that way it keeps everything germane to what I'm referring to. So this is the first objective on the downside I would be interested in. I would like to see it reach for that. I want to see a daily close below this level right here. If I see a daily close below that level, I'm going to feel confident that we're going to run the relative equal lows here and dig down into deeper portions of this. What can we look for specifically in that range? Well, it's consequent encroachment or midpoint of that, which is 14,431 3/4. So that's a key level. So that will be on my notepad. This candle's low is going to be my notepad because it's an old fair value gap on the weekly. So it's a draw on liquidity always. It's always going to be a factor for wanting to reach and revert back to that. Even if it goes through it, I don't care. It's something to have in your charts, have it in your notes that that level is going to be significant. It's salient to future price delivery for this week. It's in the realm of potential to revert back to it. And then the midpoint of this candlestick's wick, which is 14,777. Okay, so with those levels in mind, on the premium side, I wouldn't be so concerned about the high of last week, but I would be reframing the sell side imbalance, buy side inefficiency here. So you would use these levels, the 13,356 3/4, which is the high of the SIBI, or sell side imbalance, buy side inefficiency. Its consequent encroachment, which is 15,268 3/4. Is that right? Did I say that right? My eyes are not behaving like they should. Let me zoom in. $15,208.75, and then the low of the SIBI, which is 15,060.75. Okay, so it's this inefficiency here. So what we have down here is the discount buy side balance, sell side inefficiency, and this is the premium because it's above where we closed. So what's above the closing price? This inefficiency. So I would like to see price stay at the lower portion of this SIBI, not come back up into this area here, not in the upper portion. But what happens if it does? What could we allow for, even though we don't want to really see it, but what could we allow for? We could allow for it to trade up into this week's consequent encroachment, which is here. So it's about the upper quadrant of this inefficiency. You see that? This level here, which is half of this wick, is exactly approximately, I just coined a term, it's exactly approximately, it's pseudo precision, the upper quadrant of the SIBI. So let me shade that because this is what it would be acting as, bearish. So let's keep everything in germane color scheme. So we have 15,288.25. That's the worst case scenario on the upside. If we close above that on a daily chart, then to me, I'm on the sidelines. I'm not interested. I'm going to sit and wait. But as long as we remain below that and below consequent encroachment of the SIBI here, I would be expecting weakness or heaviness. And then when we get down to this level here, that would be the first objective for profit taking or a partial. And then we have the old buy side balance, sell side efficiency, which is this candle's low. That would be a target. And then you have the relative equal lows here. So they're real tight within like very close proximity to each individual price. The low of that candle comes in at 86 even, and this one's at 89 even. So we're only talking about 3 handles. So there's sell side below that. And if we reach below it, it's not going to just be reaching below it by a little bit and come back up. It's going to reach below it and reach down to consequent encroachment and probably reprice down to the low at 14,244.5. So that's what I'm expecting going forward. The levels I'd be anticipating that would be impactful for the week. You see that here now. We'll drop into the daily chart. Okay, you can see how we worked up into this fair value gap here. No. Yes. Okay, we worked off that. Just a little bit of a contrast. Traded right up into the here, cleared the buy side. I actually talked about that very area in discussions last week. Go look at this stuff. Don't just take what I just said here and say, well, ICT said it, so I believe it. Go back and listen, and you'll see me specifically point. These is a little too clean. I like to see it trade up into that area here. It did it. Bumped into it, and then what did it do? It behaved in a manner where it's seeking what? Discount. Sold off. Small little fair value gap in here, which it went through. What are you thinking? What are you thinking? Right there. We traded right through this small little inefficiency. Right there. What do you think that might offer us? It's not guaranteed, but what would you consider that to be? I used white so that way it wouldn't remind you because of the color. Inversion fair value gap. So if we gap lower down here and we trade back up to this area here, I would like to see it trade to and as much as what? The high. Why? Because we only have the high of the fair value gap. Nothing else went through it except for this one single pass. So in this instance, we can allow for it to completely trade back to, through, and have a mohawk, and that's completely permissible. And then we'll see if it offers resistance there and see if it wants to trade down below this candle's low. That will be a new objective because there's sell side below that candle's low. It's a daily low. And then we would look for it to reach down into the sell side below here. But prior to that, where else could you expect to see a partial if you were bearish? and you're just learning and you don't want to hold on to something that needs to go through all this price action here, because it could go down into this area, bounce back up to the low of that, and might scare you. What could you reach for? Consequent encroachment of this wick. It can go down to there and come all the way back up to this level here, and then break lower. So when you have these balanced price ranges of back and forth price action like that, remember, it takes a lot to rip right through that, unless it's extremely heavy and it's being powered through with a lot of other factors behind it. But we might not get that this week. So it's important to know where you want to take your partials, which would be below this low here, consequent encroachment here, and it could come back up, trade to this one here, or just a little bit below it, not take these lows out, come right back up and trade into the consequent encroachment of this. Trade right back to that, and then at a later time take out the sell side. That's what makes trading with a high resistance liquidity run, which is trading through these types of consolidations. You have to be able to pick where it's reasonable for you to take partials. So I'm tipping my hand then to you because you've spent the time here. So I'm kind of rewarding your patience listening to this. The trades that I take partials on are the ones that I'm trading inside of a high resistance liquidity run. If I'm trading on a low resistance liquidity run signature, I'm not taking any partials. They're full pulls. That means whatever I get in at, I'm picking my target and I'm just letting it go. High resistance liquidity runs are still likely to pan out and my targets could still be met, but I don't know for certain if it's going to happen during a session I'm willing to sit in front of the charts. So I have to pick out where my partials are, where I know I have a time. My day is scheduled. It may not seem like that right now because my wife's down there, probably pissed off because I'm a little bit longer than I went, but she knows that it's likely to happen, and that's why it needs to stop in the 11th of November. So she's being very, very patient. She probably already started eating without me, actually. She'll probably hit me with a grape when I go down there. But knowing the likelihood of the market presenting a reluctance to get through a balanced price range. What makes this a balanced price range, by the way? The price is offered sell side, buy side, sell side, buy side, and it left the range, all this consolidation. So it takes a more meaningful move to get through all that, and it generally doesn't happen in one single pass. So what I like to do is I like to break that range up into where it's reasonable and where it's logical for the market to at least trade to the midpoint of that wick. That could be the first target to take a partial if you're bearish. The low of that candle, the consequent encroachment of this wick, and it need not take the lows out here to still be profitable. And then down here, I expect it to try to do some kind of fake thing where it trades to this level, doesn't quite get down there yet, and maybe come back up to consequent encroachment of this wick or the low of it, and then move lower. Doesn't have to do that, but I make allowance for that when I'm trading against high resistance liquidity runs. But low resistance liquidity runs, I don't have any partials in. I'll stake my entire trade on the initial entry, and my stop, I'll just manage it to where I can take the risk away. And then once it's removed, I just let it go. Because my conviction behind the analysis and the trade is that it's more probable that it's going to go where I think it's going to go, and not need for me to scale off anything because it might have a retracement that's deeper than I'm willing to accept or be able to manage, because I can't be in front of the charts because I've scheduled this much time for my day to do this, and I have other places to be, other things to take care of, or requirements from my family. So that's that. And let's go over real quick though. Any gap lower opening at Sunday in a little while here in about 3 hours, the drop below this and an opening, if it does that, we can see it trade back up here and all the way back to the top of the fair value gap, because it's only had one pass through and nothing else has happened since the formation of the fair value gap. So very critical rule-based idea when it comes to trading with inversion fair value gaps. The rule-based idea is very specific. It's not complicated. You know exactly when to anticipate certain ones to stay open now, when to anticipate when they are going to completely fill in. When is it best case scenario for it to go halfway? You now have got that information now. So when I talk about it in my book, you'll see this video being prompted to you as a amplification of what I just mentioned about trading inversion fair value gaps. Okay, no cost. You don't need to buy my book. Okay, I just explained it here. All right, so let's go over to what kind of guy writes a book and tells everybody not to buy it? A guy that's already rich and doesn't need the money. All right, so we go over here and look at the sell side here, and there's a buy side imbalance still remaining there. So initially the imbalance starts here to here. Okay, so it looks very similar to what we were outlining on the ES. So that's this. Okay, and because in this imbalance we had all this price delivery down, so the only remaining portion of inefficiency for sell side, because it's buy side imbalance, it's inefficient for sell side, but look at all these candles we went down in. So this level here, when this candle's low to this candle's high, this is the remaining inefficiency. It's lacking sell side delivery. That means movement lower by price. So the way you use that information is below this low is sell side, and the inefficiency is here. So the market could draw down into this. These two PD arrays are discount by nature. And that's what I expect to see at some point. I'd like to see a framework that would allow me to see this inversion fair value gap, to see a trade entry and then reach down here. That would be something I would like to do. That's really, really what I'd like to do. But how we open, if we open relatively unchanged, I'm not going to be so, fever pitched to get short at that inversion fair value gap. I may elect to see it trade there, start to move lower, create an imbalance, a fair value gap on a lower time frame, trade into the fair value gap, and then use these areas down here as the draw for my trade. So what did I just give you? Not a plan A, plan B. I gave you very specific things. If it does this, I will do that. If it does that thing, I will do that. I'm not going long. Did you hear anything about going long? No. So it's not plan A, plan B. I gave you two scenarios that I feel confident that if I get them, I will sell short NASDAQ. I will sell short with a live account. I will make money with a live account trading these setups because I believe this is what's being framed. Okay? I'm not saying that you should take these trades. I'm just saying that I'm willing to do it. If I'm in front of the charts and if that materializes at the time I'm looking at it, I will use this framework to take that trade. That is not a trade signal. That is not an invitation for you to follow me. It's not for you to take it on your own. It's not for you to trade your combine. It's not for you to trade your funded account. It's not for you to try to demo trade it or tape read it. It's for you to just know what I'm thinking and how I'm utilizing the current market structure. Okay? I want you to be 100% responsible with what I'm sharing here, because I don't want you taking it in some way, twisting and contorting it, where if you do something and you hurt yourself, nobody told you to do it. I didn't tell you to do it. Okay? I'm just telling you how I see things as it is in this chart right now and how I'd use the information. All right, and I think that is going to be it, because I told you I was going to cover gold after NASDAQ, but we did that right after the dollar index. So if you found this today helpful, if it gave you greater insight about the inversion fair value gap, if I've counseled you and kind of helped you in terms of how to measure and manage your expectations as a developing trader or someone that is already profitable but just finds their way into some kind of a pitfall here and there, I'd greatly appreciate if you give it a thumbs up. It doesn't make me any more money, I promise you, because the videos that give me the most thumbs up don't pay any more in ad revenue than the ones that don't even put a thumbs up on. Okay, so it's just a reflection as you as the audience that you've appreciated me spending my time, because I could be doing other things. I don't need to do this. But if you're getting value from it, the way you tell me is the thumbs up. That's all you have to worry about. It's cheap, it's free, it doesn't cost you anything, it takes a second to do it, and it just motivates me to do more of it. Will I still do it if there's only one like or one thumbs up? Probably. But I just like to see it. It's an encouragement to me. So I wish you all a very pleasant remainder of Sunday. I'm quite certain I'll be talking to you on Twitter tomorrow, Lord willing. And until I talk to you then, be safe.